Hello, international finance students. Hope everyone had a good weekend, and we are quickly approaching the end of the course, so everyone's doing a great job. So just stay on top of things. We only have 2 weeks left, and the last 2 weeks are shorter because we just have 2 chapters in each module. So this week we're going to be looking at Chapter 13 and 14. Chapter 13 looking at the global cost and availability of capital. And then Chapter 14, after examining that cost, how are we going to fund the multinational firm? So getting back to looking at Chapter 13, kind of asking the question, how can I get capital at the lowest cost? That's the objective of the financial manager. And, in international, it gets a little bit more complicated because markets can be segmented or regulated. But this goes back to a little bit of your previous work in finance. When you think about like the cost of capital, you're going to look at things like the capital asset pricing model, if you remember that. We looked at essentially, we'd say, I take a risk-free rate plus beta times the difference between a market premium and a risk-free rate. And, that beta can change. It can be different for international markets. And you're also going to look at you think back to those days, was the after-tax cost of debt. There was a benefit that corporations get. So you would come up with some number that would be like the opportunity cost, that this is my cost of capital. Let's just throw out 8%. Just pull that out of the air. But some calculation would have to be done, so it helps us make determinations on projects. And when I acquire capital, that I would have to at least meet that required rate of return on any project. And that kind of goes back to things like net present value and helping you make decisions whether we want to take on some venture overseas or some company is going to come to the United States. One of the interesting things I was reading this week in an article, and it was a plant in Memphis, Tennessee. I think it's called Electrolux. I'm not sure which country is the primary owner. But basically they said because of the Sears failure, they no longer had the distribution centers to sell their products, so they were closing the plant. So that was an investment decision, but bottom line, it's based on the opportunity cost of capital. They were not meeting the required rate of return, so they had hit the shutdown point. So some of the things you can look at this chapter is also the idea of diversifying the portfolio from an international investment perspective. Again, the idea of systemic risk. We're never going to be able to get rid of that, but we can work on company-specific risks too. And when you're investing in foreign markets, the thing we have to remember too, like let's take it from a United States perspective, is that I'm exposed to the foreign exchange risk, and I'm also exposed to the asset price risk. So I could end up getting a double negative whammy that the foreign exchange, let's say I'm investing in a French company that's based in euros, but the euro depreciates in value, I'm going to lose money there. And if the company's stock, because they made bad decisions, goes down, I'm going to lose money there too. So there's more risk associated with investing in international markets, but it's often been used to put it into portfolios because it's important. It's another way to help diversify your portfolio. So you're going to learn a little bit more about that at CAPM. And one thing I just want to remind you about is the idea of a basis point. So a basis point just means 1/100th of a percent. So if I go from 3.00 to 3.25, that is 25 basis points as an example. So, all right, just some other quick items about Chapter 14 with funding the multinational firm. They go in the first initially starts off the use of investment bankers. They ask the question, what is the optimal financing structure? Kind of goes back to these ideas of Monolini and Miller in theory about what is the right mix of debt and equity. Obviously, as you take on more debt, the cost of debt is going to go up too. So the market will let you know a lot of times if they feel that you're taking on too much debt. But some of the factors when you think about these things, deals with the availability of capital, diversification of cash flows, FX risks, the debt, expectation of international portfolio investors. So sometimes they're willing to take on these risks. So there's different theories about that, about how management should be willing to take on risk. Obviously, they want to try to reduce the risk, but some investors are open to risk and willing to take that risk. But you're going to go through some examples of how companies raise equity globally, IPOs, Euro equity issues, direct public-private issues. Furthermore, you're going to look at different things such as depository receipts, ADR program structures, and private placements, and overall, ideas about raising debt globally. Either bank loans, euro notes, or international bonds. So look forward to your forward post this week. If you have any questions, do email me. But otherwise, have a great week, and we'll talk to you online. Take care.